Good day, everyone. Thank you so much for showing up for the first webinar, our in-house webinar, and we see a lot of participants. Thank you so much for coming here. My name is Gil. I'm from the 5ers Trading Fund, and today we're going to talk about supply and demand. This is the method of trading and market analysis that I mastered in the past decade or so, even more. And I truly believe that the whole concept of supply and demand is very valuable for anyone to understand. Well, let's start dive in and just give me your write me on the chat how much you are familiar with supply and demand, and so we know how to run with this with the content and how much we can go in depth. Okay, so supply and demand is actually a way of reading charts and understanding the market forces. What it means is that, hold on a sec. Okay, so today what we're going to cover in terms of supply and demand is, first we're going to discuss the theory and how we can really understand and clear out all the noise and all the misunderstanding of looking at or glazing at charts that don't tell us anything. I promise you that by supply and demand theory, you will be very much understanding why price is acting the way it is, why it's moving in a zigzag way, why are the zigzags are, why the turning points are where they are. A lot of information can be told just by understanding the very core concept of supply and demand. So we'll cover this. That will going to give us a lot of understanding about price action, like I said, and then we'll see how we can take this understanding and create trades, actually build a trade structure with a stop loss, with the entry, with the profit target. And if we'll have enough time, we will dive into more advanced concepts of supply and demand, because it's really, it goes from the very core basic into a very complex understanding and methods that you can apply. One thing that you should know about supply and demand, it is mainly made for working for very liquidate markets like the Forex, the main commodities, the indexes, the top stocks that are very highly liquidated. So supply and demand really works on these assets. If there's the thin liquidity assets and that are very exposed to manipulation, it will not work. So just bear in mind that supply and demand theory works where there are masses, huge amounts of liquidity. So these are the markets that it's going to work. It's a timeless method, and we'll talk about this. So now let's just take a look at this chart. There are no indicators in it. There's nothing. For most people, before they actually get familiarized with supply and demand, this kind of chart look like a noise, look like a very much like a random. I really hope that within this very seminar, within just 1 hour, we will be able to create a lot of logic into what happened in this chart in terms of the micro moves, all these little spikes. They all have a reason that can be explained by the theory of supply and demand. And the breaking points, the respecting or the turning point, the where price is breaking levels, everything can be explained with a very simple understanding of what is supply and demand. So I really hope that this got you intrigued, because once you can take a look at a naked chart with no extras mathematics applied on it as indicators or different black box solutions, once you will have this understanding, this will be a priceless add-on to whatever you already understand about the market. So the first thing to understand, and people tend to forget, that the market is a presentation. It reflects a real living, a real life behind the matrix. It's not just prices moving. It's not just about manipulations. Everything is being reflected by true events that are behind the market. The market is just presenting to us whatever happening in the globe. So just remember that every tick that you're seeing in the chart, every new price coming into your platform is actually a trade made somewhere on this globe between two sides. One is a seller, one is a buyer. They both agree upon price and quantity, and then there is a match. Then the central exchange will be matching these two incentives into one deal, and that will be broadcasted to our platform as a tick, as a new quote that comes in the market, and it will be added to our candlesticks or whatever we are looking at in terms of graphics. So just remember, every piece of information that comes in, it's a real trade, okay? And what we are actually trying to figure out in the market every time is, what is the balance? Right, we have a trade made by a seller and a buyer. And just imagine, try to illustrate this image that we're looking at. One side is a buyer, one side is a seller. If they agree on price and quantity, they would be shaking hands and not trying to push each other to the other side. Now, just try to imagine what happened in terms of the masses that coming with different intentions into the market. One side are wanting to buy the market, one side is wanting to sell. The very person from the last slide, from this slide, one of them bought the asset, and now he wants to push the market up, and once sold the market, he expects the price to go down. Okay, so the supply and demand is the actual balance between buyers and sellers. As long as the buyers and sellers having the same force pressed on each other, we will see that equilibrium situation like we're seeing now. Both hands at the same place, nobody is out winning the other. But if somebody presses harder than the other and one side become weaker or more tired, the other side will win. This is exactly what happened in terms of supply and demand. It's called order flow. And once one side will win, the other side, price will move the very same way that the hands will move to one side or another. So there are more ways to illustrate this, but just think of what is actually happening at the exchange, and I will refer to your question, Edwin, in a moment. That the forex market is not centralized one, but what happened in the market, in every market, is that at the same very price, we have many participants with different goals. Some want to buy, some want to sell. So imagine at a very certain price, they are broadcasting their orders, their desires to what they want to do in the market. They are sending their orders. So they would send a buy order or a sell order for the same asset at a specific price. With this illustration, we're seeing a situation where so many participants will be sending sell orders, and slightly more people will ask to buy the asset. So what will happen now is that I'm sorry, is that the market, the exchange will start matching from bottom to top all these files, and imagine that each file is the same quantity request. A buyer and a seller are matched, a buyer and a seller match, a buyer and a seller match, and every time there is a match, another two files are disappearing from the table. Eventually, at one point, we will have the last buyer meeting the last sellers, and there are going to be no longer sellers while there are leftovers of buyers in the market with no sellers to fulfill their request. Okay, so this is the time where price is going to move somewhere, because if now we don't have any sellers at specific price, what do you think will happen to price? The exchange will drive price a little bit higher until they will find new willing sellers to sell at higher price, right? At higher bid. Okay, so every time we have this situation where we have more buyers than sellers, price will move up. If the opposite would happen, if there are going to be more sellers than buyers, the exchange will drive price down until they find more buyers willing to buy at cheaper price. Okay, so this is the very core mechanism of how the market works. And if you think about this, it's every market. It's not just the very high-tech markets of the financial markets. It can also be the tomato markets. It can also be real estate market. It's just about what's happening in people's mind. If you know, if you're about to buy a house in a certain neighborhood, in a certain street, and you know that the last deal on this street was at specific price, you would not be willing to buy it at higher rate, or and the seller would not be willing to sell you at less price, right? So everything is derived from the last events. But if at some reason somebody will say, you know, and on this neighborhood, somebody very, let's say a big celebrity bought the house, now everybody wants to buy, not depending on the market price. They are willing to bid more for the houses, then price will rise. everything is derived by the balance of supply and demand. How much people are demanding to buy versus how much people are willing to sell the asset. So this is the order flow, which is equivalent phrase for supply and demand. Okay, so now when we look at the market, we are trying to read a story of the market and try to understand what happened, where is that situation where a leftover orders were not fulfilled, because we know that when price will come back to this price, there are certain amount of orders with high probability laying down there to be executed. So we want to know where was that situation where we have these leftover orders, because if we are going to sell where we know there are buyers in it, we will definitely get our execution, right? So when we going to look at the market, we are going, it's very easy to take this image and figure out where was that place, where was that line on the chart, and where was that? Right where price origin a drop or a rise. We see that price is ranging at a certain zone, and then suddenly price pushing upward. What happened here is there are more buyers exceeding the sellers. There are no sellers anymore, and therefore price will rise up. Okay, so that point is for sure where we know there are buyers willing to buy, and there were no longer sellers to give them orders. This is why the market had made price going to higher places. Okay, it's only when new sellers came into the market where price will start ranging. And then when price was coming back to this area of the decision to break higher, we have seen reaction and another balance situation between buyers and sellers. So what we're going to be trying to look at is the story of where buyers and sellers were agreeing, meaning range, or in terms of the supply and demand, we call it base, and where buyers and sellers didn't agree on price and didn't find fulfillment, and one side won the other. So that will be wherever we see price drop or price rise. Okay, so it's that easy. This is why we don't need any indicators to tell us what is happening in the market. And while we're looking at the history, we will make some illustration of what happened in the history, and we will see how we can forecast with a bigger probability for the outcome in the future. So we will use historical charts to try to prove that, and then we can do this in live. So we are looking to find the decision points. The decision of the decision are where price, where one side had won the other. Okay, so how we do it? First, we are going to look for the impulses in the market. Every time we see price dropping or rallying up, this is, we know for sure that there was a decision. One side won the other. Very simple to spot, right? So here we saw the sellers won the buyers over and over, and therefore price is dropping. Okay, so we see a very strong impulse down. We know there are more sellers than buyers, around here. But where would that be the very accurate place for them to time our best and accurate entry? We'll discuss this in a second, but let's see more impulses. Every time we see price dropping and after a price basing, this is where we can look up for the second stage to decide where is the decision point. Okay, so every time we see an impulse, a base and an impulse, that is where we are going to drill in and look for a decision point. So see how many impulses we have, and that's the only thing that matters in terms of charts. Okay, so now drilling in, and we see price was climbing up, basing for a while, and then dropping. Okay, where will be the decision point that we're looking for? Where will be this situation where there are no longer sellers, but there are buyers, or in the chart that we're seeing now, where will be the sellers that didn't have enough buyers, therefore price went down. So we see price basing, and then from this bar and on, we see price is dropping and never coming back to this area. So the first breakout that we can see, it's right about below this pin bar candle. So that will be here, will be our decision point. And we will mark the supply zone, the full range on top. So everything and above the highest price would be the zone that we call supply. Okay, and that is the decision point. Okay, then we stretch that line all the way to the future, and we're going to look what is the outcome for when price at the first time approach and hit this this decision point price. Remember that illustration again. At this situation, we had more sellers' files on the desk of the exchange more than the buyers. That means that some of the sellers' files were not fulfilled. They are waiting there because they didn't have any fulfillment. They are waiting to be executed. So next time price is coming, a reaction is happening here in a very accurate way. Okay, now we're looking at copper commodity. So when a decision point is hit only for the first time, we have the highest probability for price to have a reaction at this very price, and see how accurate it is. Marco is asking, they wait for a week? Yes, they wait for a week. They can wait for a year, for years. It doesn't really matter, because this decision is not just orders that are there at the table on left. There are also mental pricing that institutions are considering. There are a lot of reasons why this decision point would be active. But yes, they are waiting for endless amount of time. It can be very quick, and I will show you that, and it can be very late in the future. But bear with me on that. Don't consider time, just consider if the decision level was never being tested before, it will provide a high probability reaction, not yet a reversal, but a reaction. If you see all these different wicks and turning point while price is progressing to some direction, they are all have reasons in terms of supply and demand in order flow. These are reactions that occurs upon order flow waiting to be fulfilled. Okay, so that explains everything. So in order to explain these, we will have to drill down into different time frames. Now we're seeing H4, but we can go all the way to to 1 minute or tick chart to really understand why this price is actually reacting. And you see price is reacting to this decision. We have here a decision for price to go up. And if we'll mark this price, I hope it's horizontal, we see that price had made a reaction in this. It wasn't a reversal, but the very first time it hit a fresh demand zone, a fresh order flow of demand orders, a reaction was occurring on the market, and then price continue, and the next time price is testing the very same level, it crushes in, and then it finds a lower level where demand could be found. Probably we could see the decision. We will probably be able to see the decision on a lower time frame, not H4 like we're seeing now, but this explains, would explain, if you drill down, you will see the reasoning for why price is reacting. So every spike you see on the market is a reaction for something, for order flow, okay? Okay, let's continue. Okay, same thing for demand. We see that demand is was created here, and then when price was moving up and then returning to this demand, very quick, it made a reaction. Okay, so this is also explained if you're familiar with support become resistance and resistance become support after a breakout. This is exactly what explains it. Okay, we have a decision point for price to go higher, and then price immediately turn and touch the very first time, and then a reaction and continuation. Okay, at this specific situation, price was visiting the third time and made a reaction, and then at the fourth time it created a reaction, but not because of this zone, but because it was there was a new zone created on top of this one, and this first time visit is a reaction for the new zone just created and moved up. Okay, and another thing to observe and to understand is that after we were hitting a fresh supply, like in this situation, just imagine these files being now consumed by these sellers. Okay, we have a buyers, we have sell orders waiting at the desk, and more buyers are coming, and now the sellers create a reaction, but the pile on the desk there is getting lower now. So now with more force of buyers coming up, price was managed to push further inside the zone and find a new resistance at higher place, probably because we see H4. If we will drill down to lower time frame, we will probably see the decision point made on a lower time frame that was actually creating this reaction, okay, on the very top. So few things to understand about supply and demand. First, we are looking for the impulses. Then we're looking for the decision from where price was originating that impulse. That will tell us where is the decision point and where are those order flow packets waiting to be executed in the future. Then in our trade plan, what we're looking for is only to take the very initial and first time that zone was tested, whether it was a very long time after, like a week or a month or a year, or at the very instant after price made that decision. So that will deviolate the zone for good once it was tested, no matter what the time is. Okay, so if we are looking for our trading plan checklist in terms of supply and demand, we know only for sure that not for sure, nothing is for sure in the markets, but we will know with high probability that the very first test of a decision point will give us high probability reaction. That's it, just a reaction. We don't know more than that. Okay, we don't know if it's going to be a reversal or not. A reaction will happen. Okay, another thing about reversal, a lot of traders are trying to anticipate and forecast reversals. Even if we have a reversal at some point, usually the price will struggle for a while at that level before it will turn out to a true reversal. So at first we'll see a reaction and then more push into that zone and more retesting before the reversal evolve and actually going to be accomplished. So so even if you are looking for reversals in terms of supply and demand, you don't really have to take the very first initiative on the fresh zone because we will have more price action formats to tell us if we have a confirmation for reversal once we were hitting a fresh zone at the extremes. So don't expect to take a reversal from the very first test of a zone. A reversal require price action confirmation, and that also can be derived by the order flow supply and demand theory. Okay, so how can we build a trade? So we are going to buy the decision point, and our risk will be just below the lower swing of that zone. Okay, so that will dictate us the risk unit that we're willing to take. So just mind that if you're on a higher time frame, the zones will be much wider. So you will be risking more pips, but you would probably going to look for higher swings range. Edwin asking, does confirmation provide higher probability then? Yes, confirmation will provide higher probability, but with higher probability, you will also get less entries because if you're waiting to confirmation, not always the confirmation will come in the formation that you're looking for. So therefore, you will be missing some trades. But I advise everyone that coming with solid discipline to be able to afford yourself to miss out opportunities by sticking to your plan and not be tempted. So whether you use confirmation, you will have less entries. But if you don't use confirmation, you probably will have less win rates. So you will have to compensate that with a better risk management or a better entry profile. So these are things to consider. It really depends on your personality or how you are approaching your trading in general. Okay, so just look at what happened when price had created a demand, and then demand was executed, and we have our risk unit that had created us 3-to-1 potential. Okay, I'm not saying that we know how to take the full 3-to-1 for sure, but just to show you that as much as we buy the dips and sell the peaks, as much as we do this, we will naturally going to improve our risk reward ratio. Okay, so eventually, remember that new demand that was created here, it's probably more or less the same risk. Now the full swing had provided us a potential of 5-to-1. Again, we can't really be sure that price will go there, but since it's a fresh supply there, that would be a very wise place to end a buy order right there. So that had provided us 5-to-1 risk reward ratio. Okay, so that's only the potential. All I want to show you. For the sell order, we have a decision for price to go lower, so that would be a sell. Okay, the entry will be at the decision level. The stop loss will be just above the swing high. That will be the whole zone, and the whole zone will be the risk unit. Okay, and that risk unit, that is one risk unit. And let's see what was the potential reaction on this. Okay, so we have 3-to-1 risk reward ratio that had happened there. Okay, so now I'm not sure I understand the question, Edwin, but I really resonance by your willing to understand the why. This is exactly the reason I like supply and demand, because supply and demand really provides why price is doing such and such. Okay, so diving into the supply and demand order flow theory will give you a lot of explanation for why price is doing whatever it's doing, why it's spiking, why it's breaking levels, why it's not. So with just the things that we've just learned today, we would know that once a fresh level was touched for the very first time, we can expect a reaction. Okay, so we can scalp this reaction or take a few pips from that reaction. We can also expect that if a price was already testing a zone, that it's no longer a valid zone, and therefore there's a higher probability for this zone to be broken. So that gives us another new information about this zone. So there's and we see this example for price pushing up into the zone, and maybe later on, if price was testing again, it will penetrating more inside. Okay, so now we have like 20 minutes And let's just hop into charts and see how we can actually analyze more supply and demand situation and try to learn a few more concepts on top of this. Let me switch to the charts. Okay. Everyone is seeing the charts now? Richard is asking a question about 6-to-1 leverage. It's not relevant to supply and demand because the leverage, you say you use 200-to-1, but I bet you never use actual 100-to-1 trades. If you did with just one slight percent against you, you'll be wiping your account. So that's not really a good risk management. But anyway, 6-to-1 leverage is not, it's not risk reward ratio what we're discussing here. I'll be happy to explain to you the leverage issue if you contact us on support, and we can also set up a call and I can explain to you in specific regarding to that. Okay. Okay, so we're seeing a chart now. We're looking at euro, dollar, yen. Okay, and now we're looking at a naked chart, and what we want to do here is try to read the narrative, read the story of what happened on this chart based on the hourly candles. And you see that I'm usually using very condensed charts because I don't really care for the candle formation, if it's harami or pin bar or whatever. What I really care is about the extremes and what was the effort versus the results of these extremes. So all I care are just horizontal lines, okay? So we see here price coming from the top, and we see price is flagging. We see it's a pole and flag, and this flag is actually what we call a base, right? Okay, so that creates, so that is a demand of its own. And when price was turning, going back, it was actually reacted to this supply. Okay, next we have, let me just see if we can, okay. Now price is basing and creating a decision right about here, okay? So that's create another supply right here on this here, and this is the swing. And then next time price was testing this supply, we see a reaction. So we got the reaction already. So now, once we got the reaction, this one is no longer valid. Let me see if I have this. Never mind, I don't have that X, this thing. I wanted to, this one, okay? We have no longer have this zone. So this zone is already being taken, okay? So it's no longer exists. Now let's continue. So we see price is dropping and another base and a decision made right here. Okay, so let's take our, so decision was made right here. Okay, now price was penetrating very strongly into the zone, but it was not really violating this. And it did create a reaction, not a great reaction, but it did. But it also didn't take our stop after it was making our reaction, okay? And then when price was coming back to this zone, it's no longer a valid supply zone, therefore price can break it up, okay? So just see how much information it gave us so we can take for a high probability this reaction to scalp. Maybe it didn't made it to a mature trade, but it did give us a reaction of some way. And next time price is testing this, we know this zone is no longer valid. So we know to stay back from selling this again, okay? Because price was pinching very, very deep inside, okay? Next thing, price was dropping. We have another decision right here. Okay, and then when price was breaking down, it was touching here, and then it disqualified this zone for good. So we have this reaction back down, and it's no longer exists. Same thing on this decision right here, and then a very fast reaction, and it's no longer exists as supply. Okay, so next time price coming in to this zone, it's no longer valid, so we know to stay away, and we're not going to take a sell from these levels any longer because we had our first touch. Let me just read questions. Some price action gurus teaching fake out stop loss hunting strategy, and it seems to be valid theory. My question is, do you think it's compatible to trade supply and demand like you do and trade the fake outs? Okay. Well, the funny thing about stop loss hunting is that when you are being taught about these fake outs, is that they're not actually giving you a reliable price to say, let's sell from it. If you going to learn supply and demand in more depth, you would understand that when price is faking out, let's say it's faking out this level, it will fake out until it has a good reason to bounce from. So if you go always to the left, you will see there's another low time frame decision point up here, and that would be explaining why price was actually pushing through, breaking out, and reacting at a slightly higher level on this instance. So if you want to add more reasoning to the stop loss hunting so-called strategy, just look further to the left and see what more levels of hidden waiting packets of orders up there, and you will understand why price is faking out a specific level and then dropping. It's not just because they hunt stops. It's because the ignorant traders would put stops right here, so that would be also stopping this their trades, but and creating another packets of resistance on top of the swing, but also because there is historical waiting packets of orders waiting up there. So there is always a reasoning why price will be turning, whether it's a fake out or not. So so supply and demand will help you to understand where was that exact reason and price for the turning point. Hope I gave you a good answer, Nathan. Richard. Edwin is a bit confused. So if it hits the second time, it creates a new base again at the same spot. I guess you need a trailing stop loss then beside the 3-to-1 target. Two things I must correct you, Edwin. First, 3-to-1 target is not a definite. It's price action will tell you what is the potential range that you can ask from your trade. So there's sometimes it's going to be 2-to-1, sometimes it's going to be 10-to-1. It really depends on what price action is providing you, on what is the approach range that it's coming from. So that's one misunderstanding, and I hope you fix this. The second thing is we will discuss this in a moment, or if you will attend my trading rooms, I really discuss this a lot, where I try to analyze the effort versus the result, and that also will show us where we have a valid supply and demand that we can play upon, and if we see a fresh supply or a fresh demand that we can play with. So so that's a few rules that will help us to leave out misleading zones that can be seen visually, but with adding more logic into it, that would be helping us to avoid risky trades. Richard is asking, what do I recommend if we see stacking zones on top, one on top of each other? So there is a very simple rule to that. If we have, like we see here, supply and then another supply really stacked one on top of each other, I would tend to take whenever I see a fresh one, okay, a fresh zone. So if we see that price was hitting this supply, this supply is no longer valid as from this test, okay? So I don't consider this as a supply. And now I just eliminated one supply from the equation, and I don't have to really debate which one give me better probability. Then the simple rule is, if it's a fresh, never tested zone, therefore I can take it. So even if it's in a lower position, a lower price, it's still fresh, so I can expect a reaction, so I get the reaction from it. So that's the only thumb rule I can tell you. In terms of Quasimodo level and patterns, we'll discuss this in more depth in our trading room. I think it's too much for this session. We already an hour inside this this webinar. Anyway, so continuing with the supply, we have another price. Okay, so we have price ranging down, and now we have another decision. Now the decision is to come up. Okay, so the decision is right here. We're going to stretch the whole swing right here, and the decision here, and stretching it for the very initial approach. So we got this retest on this test on this demand, and therefore this demand is no longer exist after this price. So we see in that sense, here is another, I'll get to the point in a second. So we have another range right here, full range, prices ranging, and a decision made about here. Okay, so we stretch this. So now price was almost touching my decision point line, and there's two lessons to be discussed here. One, we can ignore this attempt and the fact that it didn't touch, and just stretch it wider, and it will provide somewhat, but it will be wrong to do so, because now we have different views of price action, and we don't really know where is that precision decision made. Okay, so if we have this decision point on H1, maybe on M15, we will see a lower decision that was made this effect. And we also see that price in terms of lower time frame, price was going down, flagging up, and continue. So we have this whole structure of pole and flag right here. So that's the one, and this is the reaction for this. And you see that it's within the decision of that flag that it was already reacted. So the lesson to be learned here is that, and I know it's a little bit confusing, but I'm sorry, that's a fact about the living daily of the supply and demand. If that's, we can draw supply and demand by the decision point like I'm drawing, but we can also be more conservative and taking the whole range from the lowest swing, the up, and the breaking of the lowest swing. So this is what I did with the pole and the flag formation. And that was the reaction for this. So in that sense, this decision point is the same structure of this pole and flag. It is actually the same packet already being consumed. So yet we didn't get this as a trade, but it did valid that supply right here. Okay, so we didn't get a trade because we were looking for a higher entry for our short sell, but it's still taken the orders out there. I mean, the price action had shown us that the packet was waiting a little bit lower. So that's a miss of a trade, but still the logic is there, and it tells us to avoid taking that trade at the other attempt. Eventually, if we did ignore it, we would get a reaction and a bailout opportunity from a bad trade. And even if we were holding this, price went only halfway into the zone, into our risk zone, and that was okay. And we would get a reaction. So we wouldn't been busted on this trade, but this is the logic behind this thing. So it's another lesson to be learned from this situation. Okay, so now we have this demand, reaction to demand, and then price is trying to push up and breaking this formation, this supply. Okay, let's just leave it out so it's going to be easier to be seen. And now price is pushing back. So now we're looking at a situation where I call it effort versus result. We see that price was not able to break higher by finding support on demand. And so we see a demand respected, but not being able to break supply. So, and then price was going to lower places. So we still, so this is the forces that we're going to be looking at all of the time. We want to see that price is being held by one side, the supply side or the demand side. And we want to see that price managed to break the opposite side. Okay, if it can't, it tells us something. Okay, at this situation, price was making a deeper push that is eventually turned out to be a fake out of some reason. If we want to understand why it is so, we usually take a full horizontal line and put it on the swing extreme, high or low, and then we go to the left and see what was the reaction for. And we see we have here a fresh demand, right? A fresh demand that price was actually reacting from here. So every time we go left, we have a way to understand why price had decided to stop here. I'm not saying that every time we would know how to forecast ourselves into buying this or to have this as a trade, but having this in mind all of the time and having the ongoing practice of always trying to explain yourself, why is this swing high just stopped here, and why this happened, why the turn that happened here, and go to the left and see why it was like that. This is the practical, the routine practice that will help you truly understand price in the naked form of supply and demand. So I see a lot of people are losing patience. So I suppose we will have to schedule another meeting with more, with discussing more advanced stuff. So thank you so much for being here today. And yeah, we'll set more webinars like this so we can discuss more in-depth stuff on supply and demand. Remember, supply and demand is something that you have to practice yourself. It's a reading concept, and it's complementary to any other strategy, whether you're using any indicators on your charts. It doesn't conflict anything. It just gives you another view for understanding the price, and maybe to keep you out of trouble or to have more confluence to your decision making with your other strategies. So that's on the tip of the fork, the supply and demand theory. And the same way we've discussed supply, and we've discussed in some cases no supply, non-demand zones after violation. There are more theories derived from this very core understanding. So we'll set up, schedule more events like this so we can dive deep inside. Meanwhile, we've covered these topics in few different occasions, so you can hop into our video area on our website or on our YouTube channel and learn more about this. And there are also a lot of information about supply and demand with different approaches from mine on the internet. So I hope that intrigued your imagination and the things that you can apply from it. And thank you for showing up today. And we'll see you next time, next Thursday. We have another webinar by Sneer or by Saul. I forgot the schedule, but make sure to come along and learn some more different views on the markets. Okay, thank you guys. Have a good week ahead, and we'll see you next Thursday, and next Monday we'll have another trading room. Take care, guys. Bye-bye.